Hello, everybody. Chris Martinson here, and today we're going to be talking about finance and economics as part of Finance U. Remember, anything that you see in this video and all resources available at our websites or affiliated websites are not intended as or construed as financial advice. This is for educational purposes. Remember, if you have a financial decision, please consult a financial professional. We are not attorneys, we're not CPAs, we are not financial managers. As well, we do our best to be accurate, and everything we represent is as accurate as we know it to be. Now, let's turn to our program. Hello, everyone. I am Chris Martinson. I am the CEO of Peak Prosperity and also of Peak Financial Investing. Welcome to another edition of Finance University, where we won't leave you in the dust. We're going to be talking about all things current around economics, finance, things like that. Today, we have got a really big episode. We have to talk about the United States government has a gigantic refi problem on its hand. It's mortgaged the country, and now it has close to $10 trillion of new paper it's going to throw into the market during a time when that treasury bond market's already weak. What does that mean? What are the implications of that? To help us understand all that with us today, Paul Kiker of Kiker Wealth Management. Hey, Paul, good to see you again.
Chris, good to see you again.
Oh, it's good to be here. You know, I'm just fresh back from vacation. I was in Iceland, and I came back with my gear. Huh?
You fit the part. How was the trip? Wonderful.
It was fantastic. I highly recommend it to everybody. It was just right for Evie and myself. Lots of natural beauty, and I really grooved with the culture there. They're very socialist, and it works for them, but they're also kind of libertarian. Like, we're walking, Paul, in a place where there were boiling pits of mud. If you fell in, bad moment. No warning signs, no ropes, no fences. Their whole position is like, if you want to fall in there, that's on you. So
At your own risk. Yeah, be wise about it.
yep. You could be up at a shoreline with giant crashing waves and really, unpleasant rocks if you fell in, of course, and no signs. So they're just like, you be you.
Now, I saw some pictures on your website that you stopped by a geothermal facility.
Yep. Their geothermal facility was extraordinary. I'm very jealous of it. It was thoughtful. They took 3 bites at that apple when that steam comes out of the ground that they harvest, and they turn 2 sets of turbines, and then the city of Reykjavik, their capital, gets free hot water in essence, because they just pipe the waste hot water. Is a hugely valuable asset, and every building just has a steam or a hot water radiator in it, and they're free hot tub for the citizens, pools, hot tubs all over the city. So they like their pools. It's good. For everybody watching this, just know that this video is just for educational, informational purposes only. It should not be considered financial advice. The promoter of this video is also a promoter of Kiker Wealth Management. That's me and my firm, Peak Financial Investing. And also, please be aware that investing involves risks, and past performance is not indicative of future results. I could let you read the rest of the words on there, but we do have a relationship. Love working with Paul and his team. And I will tell you that the feedback we've gotten from everybody who's gone to work with you, Paul, has been just spectacular. And that matters the most to me in this whole story. So let me skip back up to the top of this thing. I want to talk about this. I want to talk about this.
Wow.
Look at this. So 2 scales on this chart stretching back from January of 2000. So it's a long-term chart stretching across many years. Left-hand scale is in billions. So 6,000 billion would be 6 trillion. Right-hand scale is percent of GDP. So here we see on this, the green line shows the market interest-bearing public debt, just the public debt. So the government has both public and what they call intragovernmental or non-public debt. Just the public debt maturing in a year or less is $7.6 trillion. That's 31% of all government debt outstanding. For whatever reason, this next 12 months, it's going to be maturing. And as you know, Paul, it's maturing into a much higher interest rate environment. So the interest costs for the United States government are going to go even higher. And I would call them explodey already.
Yes, dramatically so. And it's $1 trillion in accumulation at this point now, isn't it, Chris? Am I remembering that number correct?
$1 trillion in new stuff coming in?
Well, interest that's coming in.
Oh, yeah. The interest payment, I think it just crossed a trillion. I think last I saw it was 988, but I'd heard 988 billion, but I'd heard it crossed a trillion. I didn't question that result because that's the trajectory it was on.
Yeah,
$1 trillion in interest expense that's comes out of the U.S. government, the taxpayers.
it's incredible. It's incredible. And has ramifications. You know, a lot of times people we will forget, or investors, individuals will forget. Debt is just pulling future consumption up until today. So you're pulling that future consumption into today's environment, which means that's less consumption that you can have in the future because you're spending more on interest to service the debt that you spent today, that you will not have money you will not have to spend in the future. So
Mm-hmm.
that's going to have some pretty substantial, severe ramifications, and especially not in the middle of a crisis like we had in 2008.
Yeah. Now I got to point out though, this is just outstanding government debt. So this is already excess deficit spending in the past that's now sitting on the books as debt. This is 7.6 trillion of already thrown out the door. Hopefully we spend it on good stuff, but I have my own concerns that maybe we wasted or squandered quite a lot of that on graft, corruption, and foreign wars that do nothing for us. But it's been spent. However you characterize it, it's gone. The other side of this particular story is that we are going to be seeing much more new debt on the books. So that's where the deficit comes from. A budget deficit turns into debts.
Yes.
Yeah. So everybody's kind of talking about it because it's pretty obvious. I'll show you the numbers in just a second. But um, so remember, in bonds, a lower price of a bond equals a higher interest rate because bonds have a seesaw effect, prices to rates. So this is a 10-year note. So whenever you see a red candle on this, that's the price going down, which means interest rates are going up. So already, I think it's pretty easy to see that over the past year, bond prices are already weak for the 10-year. And of course, a lot of people's mortgages are keyed off of this. So that's why if you've been experiencing higher mortgage interest rates, you have to understand this chart. This is the headwaters of the Nile on that particular story.
Yes. And it looks like it's wanting to try to break through that bottom level. The question is, will it? Is something going to save it? But it sure looks like it's wanting to. The more it tests that, the weaker that support becomes, and the greater chance that it's going to break through.
Yeah, this support level right here at the sort of the 109 level, it's sort of, yeah, that looks like support that goes back to October, November. But if we look at this, Paul, on a longer term zone, this is starts in 2000. So this is whatever, 24-year long chart here. We can see this is the behavior of the 10-year since 2021 or 20, I guess, middle of 2020. This is the Fed buying like crazy for reasons that they said was COVID, but COVID didn't start till here. There
No.
was already a big buy program undergoing in 2019, but then the whole thing sort of topped out, and the price has been going down ever since.
Mm-hmm.
And so interest rates have been going up. This right here is why houses are more expensive to own or buy at this point in time. That
Yes.
piece.
And that's back to 2007 levels. So it's been what, 15 years since we've seen interest rates. The market, businesses have to adjust to operating with interest rates at this level.
Yeah. So 2007, I mean, that's a long time ago. Do you even remember 2007? What was happening in 2007?
Oh, I do clear.
Uh,
That was right before, we were starting to see cracks in the seams of the economy. And I remember having conversations with clients that this is a time to be careful. This is a time to look at your investments. This is a time to not speculate.
yeah. So I would say, Paul, this is sort of what we would call a normal-ish interest rate environment, although the Fed was still monkeying around because we had Ben Bernanke's 1% blowout special, starting back here in 2002 and 3, which drove the housing bubble, which burst, which gave us this. This is all one giant crime scene to me for as far as the Fed's concerned. This is them intervening more and more and more and more and more. And this is the place where they threw trillions, like $4 or $5 trillion in to keep everything stabilized. And this is what's been happening ever since. And so I don't know how we get out of this without a lot of disruption because of the distortions the Fed put in there. I think I have a lot of judgments about that. I think it was ignorant and I think it was self-serving and I think it was stupid. But that's
I
just what I
agree.
think.
I agree. That's my opinion too, Chris.
Well, it hurt a lot of people. So I think that hurt is coming up. So this is the price. What's the inverse of the price? That's the yield. So yeah, this is the 10-year yield, and you can see here. Look at this. It hasn't poked its head above that level since, again, 2007 would be the last time. So this is a breakout. I think this is a big moment. That's what I think.
I think it is too. And the market doesn't seem to be paying attention to the impact at the margins that this will potentially have. You know, the NASDAQ is typically tied to interest rates relatively closely just because of the substantial amount of debt and cash that technology companies need. And we're getting higher interest rates now, but the market's ignoring that. The belief that artificial intelligence is going to dramatically change this, and maybe it does, but you've got correlations going back for quite some time that seem to all of a sudden not matter over the past 6 months, and I do think they matter. They matter. The question is how long do they continue to stay detached?
Yeah, it's kind of like you see those things in the circus where they start a plate spinning and then another one and then another one. I feel like we got like 20 plates spinning, and we're all hoping that the Fed can keep them all spinning, But
Yes.
every time they intervene, they add another spinning plate. One more thing they have to track, one more thing they're responsible for. Oh my gosh, we're responsible for the muni markets, corporates. Oh no, we got these zombie companies. Wait a minute, we've got, shadow banks in other countries we have to worry about. Oh no, what's the stock market doing? Uh-oh. It's just like this constant thing. And so my view is I really wish they hadn't done these sorts of interventions. And if I were president, I would
Right.
literally eliminate the Federal Reserve. I don't believe it's right or proper to have a private, self-interested corporation who is capable of both printing money and hiding their books. It's a
Yes.
bad thing.
Yes. Yes, a very bad thing, and I agree. If you go back and look, that it's the manipulation, it's the continued intervention in what should be a free market economy, and what it's created is this environment where the closer you are to the money printing centers and the center of that money power, the greater advantage that you have at the expense of the average American individual. So
Mm-hmm.
we would be much better off without them, and it would be a lot easier to manage money as an investor, as an advisor. It would be easier to allocate capital, because what they have turned everyone into is speculators, right?
Yep.
You have to ignore the proven investment fundamentals of the past, and essentially, close your eyes and hold your nose and walk forward, trusting that they're going to bail it out again, trusting that they're not going to allow this to come apart. But I think we put too much faith in these individuals of their ability to control things,
Yep.
especially now that inflation is starting to become a problem.
So the chickens come home to roost eventually, right? And
Yes.
I think we're close to that roosting moment here. So let me go back to this very quickly. And so the way I interpret this, tell me if you see it different, but interest rates are going to continue to go higher. This is the trend. It's been in place since 2000. It's now a 3-year-old trend. It looks like I don't see anything stopping it. And then we have that additional rocket fuel of saying, wow. And this is hard to overemphasize. 10 trillion, or almost $10 trillion worth of new financing needs for the government. And that's just, anyway.
That's
So,
tremendous. And the question is are we at the point where investors are saying, yes, you may be the U.S. government, and yes, you've been the person we've trusted most to be able to lend our money to, that we don't want to risk. But is the market finally saying, not only is the Fed fighting inflation, allowing rates to go higher, but is the market starting to take over and say, we don't care what you do, we're going to demand a higher interest rate because you're spending money like a drunk sailor?
exactly. So carrying on this story real quick, this is also true of the 5-year bond. So, there's 1 year, 2 year, 3, 5, 10, 20, 30. There are all these different bonds. They all look the same. So I just want to throw another one up to say, we're not just talking about the 10-year. I talk about it because so much keys off of that matters to us, like auto loans and mortgages and things like that. But same story. But again, critical resistance, right? What happens Paul, if we bust that 105 level, and it looks like, I don't know where we go from there.
Yeah, the question
Once,
is the next serious level of support on that chart looks like it would be back to 2000, which is in the 96, 97 level. There's a little bit of support around 103, it looks like.
Mhm.
But, I would assume that that's going to cause a little bit of chaos in the markets. It's certainly going to change a lot of the investment parameters that are out there and a repositioning of capital.
Yeah. Well, what's interesting is we're looking at the futures here. This is how we detect this. These are futures on the bonds themselves, but they're very one-to-one reflective of the price of the bonds and the actual money you would have to pay or receive if you had one to buy or sell. But there's a lot of other stuff now. So what's different now from 2007, even, Paul, and 2000 for sure, is the amount of like derivatives on top of this. So it's not just that there's $10 trillion of 5-year notes out there that people are buying, trading, and selling. There might be $100 trillion of bets on top of that: credit default swaps, interest rate swaps, all sorts of derivative bets. So when I see an aggressive move like that, again, that's one of those spinning plates the Fed has to be responsible for, which is what happened with long-term capital management back in 1998. They put some leveraged derivative bets on some bonds. It blew up. It went against them. And the Fed itself had to ride in and rescue that one dumb little, private equity hedge fund because their derivative position blew up.
Yes. Yes. And derivatives actually concern me as an investor more than any other sector of the market at this point, because all I can think of is just how much is Warren Buffett in his comment that derivatives were weapons of mass financial destruction, right? If they blow up, because there's so much money that is placed there in counterparty risk, what kind of domino does that release? And that's probably why the Fed stepped in to help bail out or deal with the situation with long-term capital management back then. But there doesn't seem to be much concern about these substantial amount of derivatives being utilized now. But those do concern me, because when Warren Buffett says something like that, I pay attention.
Yeah. Well, and truthfully, there are people whose derivative positions are getting spanked here. And of course, a derivative is a zero-sum game, right? For every loser, there's a winner. But the point is that the losses, if they accumulate too much over in one corner, it destabilizes the foundation of that corner of the building, and maybe it spreads to other firms and all that. So, all right, but let's talk about this. The U.S. budget balance is a share of GDP. They always do this, Paul, I think, to try and hide it a little bit. What's a 6%? Who knows, right? I'm not sure why they key it as a percent of GDP rather than just tell us what the dollar value is, because you have to guess what the GDP is going to be out here. But the spending is already known. Like, those are fixed numbers. So this is a guess on a guess then for me, which I don't like. Somebody's trying to guess how much the GDP is going to be going forward. And those are always, always, always optimistic 3.5% per year.
Oh, yeah.
Fixed numbers.
I mean, there's political reasons for them to overestimate what it'll be, and the future is going to be bright, and taking into consideration the unknown unknowns that are out there. So we have to assume that that's, like you said, dramatically optimistic.
So this is best case, but best case, we're running 6% deficit for the next decade. And we've only ever seen like little periods where, you have your little wartime moments. So this is the great financial crisis, and this is COVID, right? But these are basically war, as Luke Groman said, these are wartime deficits during a peacetime economy, meaning that when the recession comes along, and I think one's here and going to get worse, two things happen, right? Tax receipts fall. So, deficit blows up for that reason. And spending needs go up because, the government wants to help, and they've got programs, and, people are going to need like things like more unemployment payments or whatever. The story is, so the pressures are always there to spend more during recessions. And of course, that's sort of the Keynesian moment, which is like the government's supposed to be the spender of last resort during bad moments, right?
Yes.
Well, we've had like bad moment, and really stored up bad moments. Like, but so if we said a normal thing is like, if this is peacetime and then we spend like 3 to 4%, we have to spend 3 to 4% of GDP. Then peacetime, up then like 4%, 3 to 4% of GDP, right?
Mhm.
Um, Same story. Oops, this time it was much higher. That was a 10% spend
Yeah.
swing. So, and this time, that's just weird. But if we just said a normal thing is maybe 4 to 5%, that means that we're going to be taking this to 10 or 11%, like here.
Yes, if not more. And that, what I don't understand is why are we being this foolish and allowing ourselves to get in this position, because we don't need it right now. Is it just for political purposes? Why are they taking this risk? It reminds me of the strategic petroleum reserves. Let's pull it down now
Mm-hmm.
instead of letting it work itself through the market, because we're putting ourselves at risk. It looks like, an investor going into a recession, and not only are they investing or speculating with their emergency reserves, but they're borrowing money to invest into. So they're putting themselves at great risk financially. No foundation, no solid foundation going forward for any hard times that come.
I know it almost seems purposeful, like with the SPR. Like that was a purposeful decision to drain the nation's backstop, our insurance policy, for political reasons, I guess, at best. At worst, it's somebody saying, hey, this will harm America. I don't know what the story is, but it was not a wise or a prudent or a sensible decision. And neither is this. This is crazy. I just want to point that out. This is insane, and it's going to end badly.
It's foolish.
And,
It's
and the
foolish.
set and the setup for that is all those decades of overspending, all those decades of debt accumulation, the fact that we've got much higher interest rates right now, and so what is 6% GDP? It's more than 2 trillion a year. So we're on track for another $2 trillion deficit this calendar year, 2023, which ends September 30th. Because they run a October 1 to September 30th calendar year, not calendar, September 1 accounting year. But that's this year. Next year, probably around 2 trillion. So that's where I came up with that nearly $10 trillion, because it's 7.6 of refi plus two. Well, we're at 9.6. But if we have the recession, I think is coming, it's more than that. We're
Yes.
going to need something more. Yeah.
And it takes more and more money with less and less impact. More and more money is kicking that can down the road a shorter and shorter distance.
Yeah.
Mm.
Yeah, so I think I think it's already beginning to happen here, where interest rates are going up. They're continuing to go up. So I think interest rates are going to continue to go up here for a while. I haven't heard anything from the Fed getting ready to pivot yet. I don't know what they're waiting for. They're waiting for something to really break. I don't know what they're waiting for. But if they wait too long, it's possible these interest rates get away from them
Yes.
and continue to climb.
Well, and the question that I would have is, the market's anticipating that they're going to start cutting rates, second quarter of next year, 2024, somewhere around there.
Yeah.
So is the Fed serious? Do they want to stamp out inflation? Are they concerned about our deficits in the future and the interest that we're going to have to pay on this debt? So would the surprise be that Powell holds rates higher for longer and allows the economic damage to take place in housing and the markets and autos, and slows the economy down to the point to where our budgets are sustainable? Are they really concerned about their reputation from a long-term standpoint, or are they concerned about just keeping this party going as long as possible? Because we know what the politicians are going to want. Politicians are going to want, hey, you've got to make everything look as great as possible for now, because we just can't think long term. That's the question I
So,
have. And the surprise may be that rates stay higher for longer because they choose to, plus the market forces behind it.
yeah. So, Paul, I'm wondering, like at your firm at Kuiper Wealth Management, I mean, you got a bunch of clients. How do you how do you even begin to negotiate that kind of data that we're just talking about?
Well, very carefully. So we have to look at the long-term ramifications, the long-term risk, but we also have to look at the individual situation now and where they are, how they're allocated, and what market environments can wipe them out. And the greatest risk that most investors have right now is that the market anticipation that the Fed's going to save the day and we're going to have this Goldilocks landing. If that is incorrect, and we go back to historical fundamental levels, and we have a 30, 40, 50, 60% decline in the market, that would be financially devastating. So what we have to do is follow these indicators and use levels where we have risk on and risk off. And right now, everything's telling us that we're in the danger window right now. So we've already lowered risk dramatically in the portfolio, have a lot of short-term treasuries in there. I don't like the idea of having anything at risk above the FDIC limits. I mean, as frustrated as we can be with the government and their foolish spending at this point, and a lot of the policies that are in place, the safest asset that we can own as a U.S. citizen right now is still government treasuries. So I like those from a short-term standpoint. And then everything else in the portfolio has what we call decision points. If there's an asset class that's in an uptrend, let's continue to own it. Let's continue to own that. Let's let it have some volatility. But if it breaks certain levels, that's a decision point for us that we have to choose. If I'm responsible for a client, we're going to exit that position, lower the risk in the portfolio so that we've got capital available if these chickens come home to roost. Because if the surprise is we don't have this Goldilocks, no landing scenario, then we're probably going to see some substantial volatility in the markets and quick moves to the downside. And if you're not prepared ahead of time, you're not going to know where to get out. So we have to manage risk in these portfolios to make sure that clients are protected first.
Yep.
And then in a position to take advantage of opportunity, because when there's blood in the streets, there will be opportunity there.
Yep. I didn't bring the data with me, but just trust me. So oil is up 31% in the last 2.5 months.
Yes.
Right? Most people don't know that, but it's quietly sneaking up higher. It's at 87 this morning on the WTIC. It's a lot higher. And so that's going to feed into inflation because oil is very inflationary directly at the pump. We get that, but also indirectly, but fairly directly in almost every product out there because it bleeds into shipping costs, manufacturing, you name it, right? So it's the hidden master resource. It's in everything. So it's already higher. I don't think that this, oh, look, inflation is moderating story. I'm watching oil right now going,
right.
I think we have a problem in that story.
We do have a problem. That's a substantial impact to the inflationary numbers. Now, the balance that we have to have as an advisor is I'm not an economist, but I have to spend a tremendous amount of time researching and trusting the research and analysts that we have in place. And a lot of the analysts that we're leaning on right now are saying, hey, these inflationary numbers are not going to be declining with oil prices continuing to go up like they are. This is highly inflationary. And and then also we have a situation where Saudi Arabia cut their output, from what I understand.
Again.
So, and world oil demand, I actually have a chart here. Even with the slowdown that's taking place in China, world oil demand is starting to increase again. We had a little bit of a downtrend that was taking place, and here, Chris, I'll share it with you. So you can see this. This is
great chart. Yeah, look at that.
So world oil demand continuing to increase, ebbing back and forth. You had the big decline in the COVID shutdown. And then we've recently broken back out here. So you break out during that period of time. And this is the Saudi Arabia production output. This is from the IEA. And you can see that they've declined dramatically here. I mean, gosh, this is all the way back to what, 2014 levels. So,
wow.
So, less supply and prices starting to go higher. And the question is, why are oil prices going higher? It doesn't really matter right now because those are inflationary.
We know that coming into these next 2 quarters that we were going to have about a 1 to 2 million barrel per day global deficit, which it's a lot. I mean, there's about 3.5 billion barrels in above ground storage. So it doesn't sound like a lot. I mean, what's a million barrels per day? But it actually turns out it is quite a lot, and it tends to drive things up. But more importantly, this is again Saudi Arabia saying, hey, we're going to keep cutting here because they need a higher price to fund their economy, right? They're really targeting $100 a barrel. They think that's fair. I wouldn't disagree with them based on how amazing oil is. So, but listen, they're the producer. They get to do what they want to do. But what's clear to me, Paul, is they're not doing what we want them to do anymore.
No,
like they're just like, they're marching to a different drummer now.
Yes, they are. And anymore is the key, because I remember a time in the past where that we would ask and they would do. Doesn't seem to be the case anymore, does it, Chris?
No. no. So that's a big deal. So that is a really big deal. And so if the Fed doesn't, we have this sort of hopium story out there in the market, such as it is,
Yes.
distorted by all the excess liquidity that's still slobbering around in it. But it's got the hopium, which is like, oh, the Fed's going to pivot and it'll be a soft landing. So if those things don't come to pass, then what do you think happens?
Then I think we have a substantial and major decline in the market that catches a large majority of investors off guard.
Mm-hmm.
So, it's amazing to me that the excess optimism, just how bullish individuals are out there, because everybody was prepared. This would have been the most announced, prepared for, predicted recession that we would have ever had. But the economy's held up a lot better than what anyone anticipated, a lot better than what I anticipated. And Brian Westbury, I think, made the comment. He says, if we don't have a recession sooner rather than later, he was talking about coming in the spring of this year, it's simply because there's so much liquidity that was injected into the system in 2020 that it's still sloshing around and it hasn't worked its way out of the system yet. But where we are today, we're starting to see, or continuing to see, deterioration in the economy. But we've had one of the fastest increases in credit card delinquencies that we've seen since 2008. But if you go back to 2008, I think we were in the neighborhood of 6% unemployment. And today we're at what, 3.5, 3.6, 3.8. We're sub 4% unemployment. So it's an indication that people just can't afford the inflationary impacts, the cost of living increases, car payments over $1,000, tax costs going up. These inflationary pressures are starting to wear on people. And yes, at the chart that you have there, what the 100 largest banks is the percentage, the number is not as high as what it was in 2008, but the percentage increase, the speed of the move off the bottom here is just as fast as it was when we started there. Of course, it looks
Well, it
like,
looks like the big commercial banks have offloaded the crappy customers to the other banks, but these other banks are now at the highest delinquency rate ever.
yes, yes, they are. And that's the smaller banks, right? Outside the
Yep.
one largest.
Yep.
So, this is a time when we have sub 4% unemployment, but people are still defaulting on their credit cards. If they just, did they buy into this panic? There are so many people that believe that 20% of the population was going to pass away during COVID. They get all this extra money, buy this second house, you might not live, buy this car, borrow yourself into the oblivion because we're never going to see rates go higher again. And now all of a sudden we've seen rates go up with over $1 trillion in credit card debt for the first time. This has to be wearing on the economy. So there's a disconnect between what's taking place with the average individual and what the market's anticipating. So I think we're in a very dangerous moment. I've been talking about us being in this danger zone between now and November, and we're gonna see a lot of data about how the economy is actually holding up. September tends to be negative, so that we're not going to be told a lot unless the market just melts down here in September, because it tends to be negative. But once we get into October, November, maybe the market starts to wake up and says, hey, we're overly optimistic and overly bullish. That's the possibility during this period of time.
Yeah. I mean, I have a fairly simple philosophy on these things where, it's sort of based on this idea of the Texas card game, which is if you've been at the table 30 minutes, and you don't know who the sucker is, it's you, you know, I don't know where the risks are right now. So I tend to get pretty defensive. I'm like, take my chips off the table, go get a drink, that's how I roll in these moments. But I know there's much better opportunities coming. That's my view. Might be wrong, but that's how I see it. So I'm just preserving dry powder for the moment and watching, but getting my buy lists ready. So, I'm a big fan of energy, all its different forms at this point, mostly oil, uranium, things like that. I'm a big fan of where these commodities have to go at these points. If you believe in the future, that we're going to have a future economy and all this stuff. If you believe that we're going to have to migrate towards clean energy, there's some astonishingly big stories there in terms of copper, lithium, basic things, right?
Yes.
But I'm very skeptical of the darlings of during these last moments, like Nvidia, right? I
Yeah.
don't have any interest in Nvidia. I don't have any positions. no disclosures to make here. But I've watched that story unfold, and it's just pure hype. And I've just gone into their latest earnings statement with pretty good rigor. It looks a lot like what I was seeing in 2000. There's some shenanigans, just same old tricks, you know? Like
Yeah.
where did this big fat piece of revenue come from? Oh, it came from this one company. Who owns that company? Oh, the same people who are pimping Nvidia. It's just like it's one of those stories, you know?
It is.
It's,
It is.
yeah.
So, and I do agree. I can't sit here and tell investors that to sell everything. That there's no recommendation from that standpoint. But this is certainly
Mhm.
a time that you should look at every position that you have from a historical standpoint. What's our 20-year price earnings average on this stock? Is the market potentially overestimating how quickly artificial intelligence is going to impact? And have we figured it out this quickly? Because 9 months ago, nobody was talking about artificial intelligence. So yes, it's new. It's has substantial implications for businesses going forward. But how quickly and is our first initial reaction exactly how it's going to unfold over the next 5 years? So this is a
Mhm.
time to be careful. This is the time to raise cash. This is a time to prepare yourself for the opportunity that's inevitably going to arise as this artificial manipulation of the economy starts to lose its grip and we get back towards a free market and we have a reset. They talk about the great reset where you'll own nothing and be happy, but these markets may be getting ready to bring out a great reset and push those hands of control out of the way. And we've got to be in a position to take advantage of that to survive long term. Because from 2000 to 2014, the S&P 500 went nowhere. So if you're an investor, you're coming into retirement in the year 2000, you endured two 50% declines, 47 and 57, two 50% declines and had no positive return in the S&P 500 until 2014. That's devastating if you're walking into retirement. So when you look back over history in the late 1990s, it's clear in hindsight, hey, this is an unusual period of time that we've been through. Maybe we should peel back some of our profits. Maybe we should lower our risk just a little bit and put ourselves in a more resilient position going forward. So in our case right now, we're about 60% in treasuries. Recently, we've sold a few positions off in late July and August, and we've got a few positions like some energy positions and NASDAQ and a few others. I'm not recommending that anybody go buy this right now, just talking about where we are, where we're very close to that line in the sand that if we break some support levels, we're going to sweep that off the table, harvest some profits. And who knows? I can't tell you, Chris, that we don't have a little bit better news than expected. Maybe this slows down and
Mhm.
then we don't see that recession until second quarter of 2024. I think it's going to be here before, but who knows? It's just an estimate from, we're all taking a little bit of a educated guess when we look at it. But, if it does get kicked out the second quarter of 2024, you're going to have the election cycle that's coming up. People are talking the
Mhm.
positive seasonality from November until May. I can't say that we don't reach all-time highs or make new highs before this is over, but all that's going to do is give an opportunity for the big institutions to offload their positions to the retail, because if we reach new highs, then retail is going to be, I can't take it anymore. I've been sitting on the sidelines. I thought this was going to happen, and they move in. That's why it's important to work with somebody who can pay attention to these details. We're not going to get it perfect, but we can be adaptive enough to make sure you're in the right place the large majority of the time. And sometimes just say, hey, look, just be patient. Just sit back and wait. This is not a proven market move right now. This could be pure speculation, because it amazes me how much bullishness is out there right now with what's taking place.
Yeah, me as well. But I was reading a book by Will Durant, the famous historian. The guy must have written 1,000 pages a day. He's got all these fat books, and you can read about today, word for word. Athens, about 30 BC, when they went through one of their debasement cycles. Speculation took over. People stopped working in productive things. They've joined the equivalent of using their big brains to make better quant programs to help like feast. Because you know what? Building a business is hard work. It involves risk. It involves people. It involves products. it involves all of that stuff. If you can get that or greater profits by pressing buttons and playing in the game, we're humans. We love the incentives are clear. You
Right.
do this, it's less chance of ending up with like dirty fingernails and a broken arm, right? It's just like it's more money for less work, right? That's just how we're wired. So I see that the great crime was that the Federal Reserve was fundamentally monkeying with our social structure. One, by throwing young people under the bus by saying, you know what, we're going to make houses real expensive on y'all, right? That was a policy decision. I think we should have talked about it. I think maybe people should have asked a few harder questions, at those Fed meetings at the Senate and the Congress, right? And then two, they said, we're also going to reward certain sectors of the society, and then three, they enabled all these different speculative behaviors. They ignited those so-called animal spirits, but those aren't animal spirits. That was like mob behavior. It's just gross speculation. So that's what we got. We got a lot of speculation. We got people who are very good at it,
Yes.
but humans have been here before. When you debase the money, you debase the social contract, currency, and productive machinery of your country.
You do. And the case for real assets, Chris, I really like from a long-term standpoint and looking forward to the day that we can over allocate towards real assets. Bank of America's Global Research put out a graph here recently, and I'm going to share this with you here. Can you see this, Chris?
You sure can.
So real assets versus financial assets. So one of the things that you were talking about was how everything has become financialized so that we're pushing paper instead of producing real things. So this goes back to 1925 here and just talks about real assets versus financial assets relative to price. And we're at an all-time low here. So we don't know at what point this is going to change, but from a long-term standpoint, that's an area that has, if we normalize, if we step back towards a real asset-based economy, towards a more free economy, that's where the real opportunity is. And that's what can provide a substantial amount of inflation protection going forward. And one thing I have a lot of conversations with clients and prospective clients about, I'm absolutely terrified from a long-term standpoint of inflation. Because deflation is a lot easier to prepare your investment portfolio for. If we have deflation, prices go down. It's easy. We move over into government treasuries. You protect those assets. You don't lose any principal. And as the value of those assets go down, your purchasing power increases. So you can be wise and prudent and sidestep a deflationary event and increase your wealth during that period of time. And a lot of times what we see during a deflationary event, when we allow the economy to reset, is your wiser individuals, your longer term thinking, those who can make the sacrifice today to put themselves in a better position for the future, will regain control of those assets. A foolish company, well, not all companies that fail are foolish. I've known some wise individuals that had to expand right before the 2008 crisis, and they just bad timing, right? They made the right business decision, but the economic environment took them out. But there are a lot of foolish decisions that lead to failures of business. So then you have wise individuals that come in with the capital to take that business and take over. That's how we get better in the future. The inflationary outcome is government says, okay, we want to prop up what's taking place right now. So we're just going to print until we have a currency collapse and inflation takes over. There is no conservative way to protect your purchasing power against inflation. So, you have to invest in a completely different manner going forward. So a lot of the conversations I'm having with individuals is I hope we never see this day. But if we do see this day, I need to talk to you about how we need to change your investment approach to make sure that you're successful during this period of time so that you're at least 1 or 2 steps ahead of the average individual, because that may be the difference between maintaining your purchasing power and not. That may be the difference between, having the retirement that you were looking for and being in a position to protect your family versus not. So we've got some volatile time, very potential volatile times ahead, and you're going to have to think a little bit different to be successful.
Well, speaking of talking a little bit differently, if anybody calls you, Paul, and they say, I got this money in the market, but I'm thinking maybe I should buy an 80-acre farm and get some goats, you would be the right guy to talk to
That's right. That's
because you've done that, and I've done that as well. Like, we have to really think creatively in environments like this because we just don't know which way this is going to go, and there are a couple of future possible states which is like this could go pretty bad, either hyperinflation or even hyper deflation. Things get wonky for a bit, and
right.
so I think people do need to think creatively, and we have to stretch. What do we mean by investment? Because investment used to mean I send my money to Wall Street and cross my fingers, right? Investment could mean I got solar going in. I'm not sure it's going to be a great investment, but for sure I know that my future energy bills are locked at whatever I just put into this, right? So I get some form of stability and control, but insulating my house, there's an ROI on that that's really positive, et cetera. So that's investing now. And as well, of course, I believe in financial freedom. I believe in freedom of thought, intellectual freedom, financial freedom. And I
Yeah.
want people to get to that financial freedom, which I define as having passive income or multiple income streams that are immune from the vagaries of the world, that allow you to live the life you want to lead, so you can be content and happy and find meaning and purpose. And different level on that for all sorts of people. But fortunately, I'm not a world traveling 5-star hotel kind of guy. So keep this
Well,
simple.
especially,
I like my tractor, but it's about as extravagant as I get.
oh, I love my tractor too. There's nothing better than a Saturday to get on a tractor and listening to something that educates you while you're cutting pastures or tilling
That's the life.
fields and preparing the garden. So
Yep.
I'm actually going to get to spend a good bit of this weekend on the tractor, and I'm so looking forward to it.
Likewise, I've got a lot of tractoring to do because we're getting ready. Because I should announce. So for people who maybe still are on the fence, we have what we call the Honey Badger Gathering. That's here at my farm with Evie and myself and a lot of other really wonderful people. So if you feel alone, you feel isolated, you feel crazy, you're not, come check it out. You'll find that there's a lot of very awesome people who are curious. We're open-minded, but this is about coming together and having fun, and fairly informal. We've got a bunch of great content and lectures and speeches and talks and things. Paul, you'll be given one.
Yes.
But we'll be talking about all kinds of stuff, everything from finance to sheep to whatever, personal protection and home security thing, everything you could imagine in a changing world. But most importantly, there's the bonfires. People get together, they find each other, friendships are made, and a lot of people are camping out here in September. So that's September 21st, 24th here at Honey Badger Farm. So if you haven't yet got your tickets, you might want to consider coming. It's a great event. So I'm really looking forward to that.
I'm looking forward to it as well, Chris. And my wife and I were talking last night. Have you booked my plane ticket yet? I'm like, yes, I have. So she's so excited about coming up and
Good.
one of the events that
Yeah.
take. So it's going to be
I
fun.
can't wait to meet Holly. This is gonna be great.
It will be.
Good. All right. Well, thanks for that. Thanks for your time today. As always, really appreciate it. And we'll see you next time.
Good to see you, Chris. It was my honor. Have a great day.
All right. Bye-bye. Hello, Chris Martinson. I'm the CEO of Peak Prosperity and also Peak Financial Investing. And after watching that, you're probably wondering, well, what do I do with my money? Look, you both deserve and need somebody who can talk to you about what's really going on in this world, understand the situation as it is, not be steering you towards certain things that don't make sense for you or just keep you in a game that's already ended. Look, if you want to talk to somebody about the petrodollar declining or what is happening with gold or which sectors are actually the best ones to be in, given what the Federal Reserve is up to or the federal government, you deserve to talk to somebody who can answer those and has a few gray hairs and has been there through some of the economic cycles because, hey, we're in another economic cycle, so it's good to have that experience. Fortunately, at Peak Financial Investing, what we do is we go out and we scour and we look for the very best firms out there who satisfy one thing above all else. They've got great experience coupled to great customer service. So if you want to come by peakfinancialinvesting.com, there's a very simple form you can fill out, just a few fields. You hit send. What happens is an email gets triggered out. It goes to an endorsed firm of ours. You will get an email back. You can then set up a phone call for a 30 to 45 minute free, no obligation, no pressure call to find out if this firm is a good fit for you and to find out if you're a good fit for the firm. It has to go both ways. And if all that matches up, this will be one of the best things that could happen to you this year. So please come by peakfinancialinvesting.com. Very simple process. We would love to help you if we can. Thanks very much.